Welcome everyone to today's video in which I'm going to explain why I keep buying PayPal stock, despite the stock being down 23% in the past week. And in fact, if we take a look at the max chart, the stock is almost at the same level it was in 2015. And this 20% drop in a single trading day was mainly due to their earnings, which were very bad, although they still had some positive, which we'll talk about later. But first, the negatives. Branded checkout was down 1% year over year, which is very bad, and also transactions per active account were down 5% year over year. Another negative was their guidance, because for the full year 2026, they are expecting a slight decline in transaction margin and also in non-GAAP EPS growth, low single-digit decline to slightly positive. And the main reason why the stock was down is because PayPal appointed a new CEO, Enrique Lores, which was the previous CEO at HPQ, so it's not really a payment business. And also he was part at the board of directors at PayPal. And this was a bit of a weird decision because PayPal named Alex Chriss, now previous CEO, on September 27, 2023. So Alex Chriss was CEO for only 2 years and a half, and investors thought that he was doing a pretty good job, and also turnarounds take time. So people are wondering if he was removed as CEO for other reasons, maybe some internal reasons at PayPal. But despite all this drama, PayPal still had some positive in their earnings. Going back to their guidance, PayPal guided for adjusted free cash flow of $6+ billion and share repurchase of $6 billion, which is going to be huge for investors. And also the company is still growing. I mean, year-over-year revenue growth came in at 4%. And you don't need a lot of growth from PayPal in order to make insane returns in the next few years, although we'll talk about that later more in depth with the discounted cash flow model. And in my opinion, another positive highlight was the 2025 Venmo ones, because they reported 20% year-over-year growth and they are generating $1.7 billion. And this is considering they've had issues monetizing Venmo. I also wonder, how would Venmo be valued if it was a separate business? But now let's take a step back from their earnings and take a broader look at the company, because earnings are just one quarter. PayPal's current market cap is $37 billion and they are generating $33 billion in revenue and $5.41 per share in profit. Analysts have a price target of $66 per share, meaning 63% upside. And the company is now trading at a forward PE of 7, which looks very cheap. Now the company, despite being down 85% in the past 5 years, it is at an all-time high in terms of financials. If we take a look at revenue, it has grown from $10 billion to $33 billion in the past 10 years. Now, if you remember the chart, PayPal is almost at the same level in terms of price as it was 10 years ago. However, revenue has tripled. Net income is also at an all-time high of $5.2 billion. And again, this company 10 years ago, the same stock price, was generating $1.4 billion. So profit has 5x'd. Now they even have more free cash flow, currently sitting at $5.5 billion. Now with this free cash flow, they are returning a lot of value to shareholders, mainly with share buybacks. This is huge for investors. Why? Because you own more of the company and you share the profits with less people, basically by doing nothing. This is going to drive EPS massively in the future and your returns will get a lot better. And as you can see, the cheaper the stock has gotten, the more shares they've bought. In fact, in the past 2 years, they've bought back 6% of their shares annually, which is huge. Now, PayPal also has very good margins. Gross margin is at 41%. Profit margin and free cash flow margin are between 13 and 16%. And if we take a look at the financial forecast, analysts are actually more optimistic than I am, as they have PayPal growing revenue between 6 and 8% over the next 4 years and reaching $43 billion in 2029. Now in terms of EPS or profit, from $5.87 per share all the way to $9.23 per share in 2029, which would put them at a forward PE of 4. And another positive and a reason I would say PayPal is not a risky investment is because they are in a very good financial position. If we take a look at their balance sheet, they have $10 billion in cash and $12 billion in debt. So they have tons of cash and they can almost pay all their debt right now. And as we've seen before, the current market cap is $37 billion. Now let's talk about the main reason why I am buying PayPal stock, which is obviously the valuation. They are currently trading at a PE ratio of 7.4 and a price to free cash flow of 6, which just right off the bat looks extremely cheap. But in order to take a deeper look at the valuation, I use my Google Sheet. This tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. And as you can see, the intrinsic value according to my low assumptions is $69 per share, middle $95, and high $127 per share. Now, because the stock is now trading at around $40 per share, it means that if my low assumptions occur, you would get a 21% annual return on your money, middle 28%, and high a 35.5 annual return on your money, which is insane, and this is obviously the main reason I am interested in PayPal. Now, I also believe my assumptions are reasonable, as I have PayPal growing revenue between 3 and 6% annually over the next 7 years, averaging a profit margin and free cash flow margin between 13 and 17%. I assigned the PM price to free cash flow at the end of the 7 years of 13, 15, and 17, and I also assume they buy back 2% of their shares annually. But if you want to make your own assumptions, I'm going to leave a link to a spreadsheet down below. Super simple to use because I've done all the calculations in the background, so you only need to input your assumptions. And by the way, these returns include the dividend because dividends come from free cash flow, so you cannot double count them. And PayPal now pays a dividend, which has a yield right now of 1.4%. Now, it is true that the payout ratio is very small at 5%, so it is a very safe dividend. The payout ratio is what percentage of their profit is used to pay that dividends. Now, I would prefer if they buy back shares. I think it is much better for shareholders, or if they reinvest it in the business, but either way, it's a very small percentage of their profit. By the way, if you want access to stockanalysis.com, which is where I've shown all the data in this video, you have my code in the description. And I think we have to finish this video talking about stock market investing mentality. The first thing that I want to say is that we don't know, nobody knows where the bottom of PayPal is going to be. Maybe the stock falls even more to $20 per share. I don't know. And also, it is impossible to time the bottom. For example, I remember when I was buying Meta stock around $130 per share, I kept buying even when it dropped all the way to $80 per share and the stock fell 33%, which right now, if you take a look at the long-term chart, looks like nothing, but at the time, you still had to stomach a 33% loss. The same goes with Alibaba. I was buying around $90 per share and the stock fell all the way 23% to around $70 per share. And now that stock, again, I am up over 100% and on Meta over 500%. So if you invest in individual companies, you have to be able to stomach those losses. And the second thing I want to mention is that you never know if an investment is going to be 100% correct. But in investment, it's about playing the odds. And if in my portfolio I had 50 companies like PayPal, I am sure I would beat the market comfortably. I hope you found this video valuable. Let me know what you think about PayPal stock in the comments, and I'll see you in the next one.